Joining me now is former Federal Reserve Governor Randy Kroszner, who is now the Deputy Dean for Executive Programs at the University of Chicago Booth School of Business. It's great to have you here. What would your message be to investors at a time when your former colleague just said the Fed basically needs to sink the stock market, referring, of course, to Bill Dudley?
Well, I wouldn't go so far as say it needs to sink the stock market. I think what it needs to do is maintain its credibility on inflation and perhaps increase that. So, as you mentioned, inflation expectations have started to move up, but they can't let them move up too much. If they wait too long, if they're not aggressive enough, those expectations start to move up. You get into a late 1970s situation, and you have to remember the last time inflation was this high 40 years ago, Paul Volcker raised short-term interest rates to double-digit levels. We don't want that. That's going to sink. That's not only going to sink the stock market, that's going to sink the economy.
Yeah, and what Bill Dudley is saying is that the Fed is going to have to inflict more losses on the stock market in order to tame inflation. Do you think that's right? I mean, again, let's look at the landscape since they've started this really hawkish pivot, and we've seen five-year break-evens move higher. The 10 years are still holding in roughly steady, but they've moved up this year. Real rates, because of inflation, are deeply, deeply negative. So his point is that the market is not reacting as if it's tightening. Now, granted, the last couple sessions, we've seen a bigger change in tune.
Yeah, I think it's going to take a little while for the market to digest all of this. And we still don't know exactly what the consequences are going to be for the broader macroeconomy. Remember, we have an 8% inflation rate. Interest rates are, near zero. They probably will go to 2.5. That's still a very negative real rate, an inflation-adjusted rate. So it may be that even if the Fed gets to 2.5%, that doesn't necessarily have to tank the stock market, but it certainly will slow growth. And I think, unfortunately, they have to risk the potential of a recession.
Yeah, Goldman's call is still that we're only going to see about 1% to 2% of real GDP growth this year. And they said that still might not be slow enough to bring down basically wage inflation, so that the risk is they need to do more. Tell me what you think. I mean, $1 trillion of balance sheet reduction, does that sound about right to you? Mechanically, any concerns on that front?
Well, I think the key thing that the Fed has to think about is to make sure that markets continue to function. I mean, we've seen some, when they originally intervened back in March of 2020, the Treasury market wasn't working. And it was extraordinarily important for them to intervene to try to stabilize that market. And so they need to bring the balance sheet down, and I think relatively rapidly, but they have to make sure that markets function. That's very different than whether markets are, going up or going down. They just have to be able to make sure that they maintain the liquidity. And that's the key thing that they have to look at as they bring the balance sheet down.
Right. And we're looking at numbers that suggest they could be reducing it by a pace of about $1 trillion a year. I mean, these are enormous numbers, and some will be reassured and they'll look at the yield curve and say, this is what the market needs. Let's get the Fed out of that market and kind of let the normalization happen. And others will say, we have no idea how markets will react to this. And we could see bigger dislocations from this and from rate hikes. I think you're also in the half-point rate hike camp, at least once, maybe multiple times.
Yeah, I mean, the Fed needs to move. They've been slow to get to the party, and now that they're at the party, they really got to get moving. Because, as I said, you don't want inflation expectations to get too far out of control, because that's what happened in the late 1970s, and that means that you then need to raise rates extremely high. So they need to actually raise rates more rapidly now to try to avoid something that is going to be much more of a crunch later on. And that involves both interest rate increases and the rundown of the balance sheet. And then, as I said, they just have to be aware of making sure to maintain market functioning, because we certainly will see more disruptions, whether it's like what we saw in the nickel market and the London Metals Exchange, like potentially what we saw a few years ago with the Treasury securities markets. They'll be aware of that, but they do need to bring it down.